Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Aaron and Trishul have fun with math. Granted, this is likely the last thing you think about when it comes to having fun. But at least they end up entertaining themselves. The two discuss compound growth, Manhattan, and Benjamin Franklin. They also relate how the easiest way to benefit from compounding is to start early. Even so, it's never too late to begin planning for the future. They then explain how and why the rule of 72 works. And in the end, they ask each other their favorite numbers, just for fun. And now, on to our conversation.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So this is our first episode of 2021, and as a way to kind of congratulate everyone for making it through 2020 and surviving, we're going to keep today's episode a little lighthearted, just kind of have some fun. And when I say have some fun, I really mean that Trishul and I want to just kind of entertain ourselves. So Trishul has a bachelor's and master's in computer science and MBA in finance. My bachelor's degrees are in applied mathematics and philosophy. So today we're going to kind of have our own little fun with math. And if you want to kind of tune out right now, we totally understand. There's nothing really applicable to some of the things. It just kind of helps people understand some of the math that we've referenced in the past and kind of clarify things, but also just other observations and nerdy anecdotes that we have. So Trishul, why don't you get us kicked off? When you think about fun with math, what are some of the things that you've observed and then kind of used to really show benefits of math and how we can start use that to think about the real world?
Well, one of the coolest things that I like about just the way the math works is with the notion around compound interest. And we've talked about this many times, and kind of the tagline when this topic comes up is that it's been said it's the most powerful force in the universe. This notion of compounding. If you just kind of think like biologically, we have systems that kind of grow exponentially. Of course, there's our human population, which is kind of taking over the planet. But even if you boil that down to just standard bacteria, one of the ways you can think about it is a bacterium will double every 20 minutes. So 1 will go to 2, will go to 4, 8, 16, 32. And within a short period of time, if given enough resources, you'll have more bacteria than the weight of the planet. Now, that's just the notion that when something doubles in that short of amount of time, it doesn't take too long to go from, a billion to, 2 billion to 4 billion to 8 billion. And then, you start getting into the trillions, and then it just starts getting quite silly. So it's an interesting thought that, if something can grow with this notion of compounding, it does lead to exponential growth over time.
So do you have any kind of good examples of that?
Well, if you tie it to money usually doesn't double, but it still has this notion of compounding because it grows at a certain percentage. And just to take a very simple example, let's say something grows at 10% per year. Well, naively, you would think $100 would grow to maybe $130 after 3 years, 10 plus 10 plus 10. But because after the first year, you have $110 and that grows by 10%, then you end up with $121 the next year. So you get like an extra buck after that second year. And then after that third year, you end up with actually $133.10. So instead of getting $130, you have $133.10. So about $3.10 more because you're earning interest on interest. That's the value of compounding. And again, these numbers sound small, but if you take this out for a longer period, you actually see almost silly growth. And that's kind of where my next story falls into place.
So I do like that idea of compounding. And before you get to your story, when I think of rates of returns, one of the things that I do try to, I guess clients are aware of, but like when the market goes down 50%, you can't get back to where you were with a positive 50%. You actually need a 100% rate of return. And it works kind of the same for any percentage. If the market if your $100 goes down 25% down to 75, you actually need a 33% return to get back up to $100. And it's just another way to think of the power of those kind of percentages, I guess I'd say, that the 10% compounding, and it's one of those, like, the difference between arithmetic averages versus geometric averages. Those are specific math terms, but in this case, if you got a negative 50 and then a positive 50, your arithmetic average is 0. So you kind of plus 50 minus 50, your average of those is 0. But your geometric average accounts for the amplitudes and the fact that that positive 50 occurring after the negative 50 means that you only got back up to 75. Your geometric average is still negative 25. And it's the same thing with your compounding of 10%. An arithmetic average would be 10% per year. And if we got exactly $10 per year, then we'd end up at that 130. But when we do the compound, we get that geometric average, and the geometric average of 10% is greater than that arithmetic average of 10%. And that's one of the kind of, it's the things to be aware of with kind of compounding and looking at rates of return and actually looking at data is this an arithmetic average or is this a geometric average? Because geometric is what average rate of return would we need to get to this level. And so that's just the negative 50, positive 50 is the best stark example to understand the concept, but it does come up with anytime we're looking at rates of returns and what you would actually earn if you got a compounded 10% rate of return. So sorry for interrupting, but continue on with your example of compounded rates of return when we're earning interest on interest.
Yeah, happy to. And I do like that example you just threw out there, Aaron. It's just something to realize when you're dealing with returns and how you're watching them grow. So definitely a keen insight to pull into the picture. And yeah, so the example that I want to throw out there is something that probably we've all may have come across, certainly if you've been in like an intro to finance course or something like that, where the kind of story that we may have heard is about the American Indians who ended up selling Manhattan to, I believe it was the Dutch settlers at that time, for a bunch of trinkets, basically. And the notion is that the Dutch settlers ended up taking control of perhaps one of the most valuable real estate zones on the planet for basically almost nothing. And that's maybe how the history book story ends, but that's where kind of like the finance textbook story begins. Because part 2 of that story is what would have happened if the American Indians took that money that they received and actually invested it over the last X amount of years. So this transaction, hypothetically, who knows, it's probably like a myth at this point, but hypothetically it happened in 1626. So that's almost 400 years ago. And there's some notion of how much, these trinkets actually cost. And in today's dollars, maybe it was like, $24 worth of trinkets or something like that. So what happens if you invest $24 in the stock market for 400 years? What if the American Indians went home with that $24, deposited it in their account, and logged onto E-Trade and placed a trade to buy the S&P and held it, and reinvesting those dividends for about close to 400 years? Well, it turns out if you do the math, you would have close to $8 trillion. And part two of the story ends with the notion that, well, at that point, the American Indians could actually have bought back Manhattan and had some money left over for some other smaller cities. And it just gives you this notion of, well, $24 compounding at a 7% return. We mentioned that might be a good long-term proxy for the S&P, could provide a almost silly amount of growth if it just is left there to grow over many hundreds of years.
So it might be the case that the payment from the Dutch to Native Americans might have actually been a fair price for the land that they were buying at the time, if we assume that this kind of 10% discount rate.
Yeah. So the part of this is not really to say that that's hypothetically something that could have happened. Again, a market didn't exist to obtain this level of return.
It would be hard for Native Americans to invest in the Dutch. It was the Dutch flower petal, the first bubble we talked about.
The tulips, yeah.
Yes, yeah. The tulips. So, but like, it would have been hard for the Native Americans to invest in the first stock markets in Europe in the 1600s to get that compounded 10% rate of return.
Yeah, 7%. Yeah.
Sorry. Yes.
Part of this story is the notion that, well, we have $24 and we do have access to E-Trade, and we could, just as a thought experiment or even a real life experiment, leave $24 and see what happens after 400 years. It'd be interesting, right? We would all be trillionaires by this math. Well, not us, but our.
So now it's like what, 25 years per generation. So 12 generations later or so.
Something like that. But would you really miss that $24? So, yeah, I for one think it would be a pretty neat experiment.
That would be pretty cool. It also reminds you of the anecdote of kind of the value of an ounce of gold or a gold coin. Kind of in ancient Rome, you could buy a toga or kind of a full set of clothes for about an ounce of gold or a gold coin. And these days, if you have an ounce of gold, just based on current prices of gold, you can buy a full suit of clothes for about the same amount. And it's a really good idea of just how well gold has kept pace with inflation over a couple thousand years. And it's more anecdotal because we don't know enough about the price of togas relative to the value of gold in Roman times, but we think it's pretty close. And it's another good illustration that there's a kind of a difference between compound equity returns and just gold keeping pace with inflation. But yeah, gold is kind of worth the same thing because there was no dollar then to be able to compare it to. But if you think of just a full set of clothes cost about one gold coin, and these days it still costs about one gold coin. Just the value of the gold as measured in US dollars has gone up quite a bit.
Right. Yeah. And to kind of apply that to our Native American myth story, well, instead of investing that $24 in the market, if they had basically bought some gold, well, they might just end up with where they started after 400 years.
Yes, that's a great comparison. They still have enough to buy the trinkets, not enough to buy the island of Manhattan back.
Yeah. And it kind of makes you want that 7% return a lot more than that gold, I hope, or at least that's the connection that I made in my mind.
What I tell clients is kind of one of the big reasons we use stocks and equities, even when we're trying to be at our most conservative time point, usually within kind of retirement plus or minus 5 years, is that we need the stocks to outpace inflation. And that is one thing that equities have consistently done over, again, hundreds of years, if not longer, that we need to make sure we're outpacing inflation, not just kind of keeping pace with inflation.
Yeah, that's a very good point. And over long periods of time, inflation can erode your savings if it's not trying to keep pace. For example, just sitting in a bank earning close to nothing means at just a 2% inflation rate, you'll lose half your value in 35 years. Again, not in 50 years, but in 35 because of this notion of compounding.
Yeah, so I did if we take our $24 and we have it grow at 3% per year over 400 years, we have $3.2 million, which actually, like, when you think about it, like, just if that's just inflation, if that's what the Dutch paid for the island of Manhattan, that actually sounds like a lot of money, like just to buy a undeveloped, unpopulated tract of land for $3.2 million. I mean, that alone sounds like a pretty good price. But when you do it by that 7%, my calculator gave me the 1.36 to the 13th. So I need to kind of quickly remember how many zeros that is. So that was that. What you had, $13 trillion? Was that the math that you had?
Well, I had 8 trillion, but it was only 392 years instead of 400. So that last X amount would probably make up that difference.
Okay. So yeah, so that's the difference between compounding 7% over 400 years or 392 versus 3% over the same time frame is a few $trillion.
Yeah. And, frankly, I feel fortunate that we live in a time where we can get that 7% or we have access to that 7%.
Yeah.
Like for example, Benjamin Franklin also has an anecdote tied to this notion because he also understood back then the power of compounding. And he kind of set up a little experiment, as he used to do, where in this particular experiment, he said, how about I leave a certain amount of money and have it not be touched for 200 years? And that's exactly what he did. He left it to the individuals in Pennsylvania, and he signed it over with this notion that it wouldn't be touched from about 1785 until 200 years later. So, 1985. What he had left is about 1,000 pounds, which is about $4,000, which is probably his whole salary at the time, or which is about 100,000 in today's dollars. And he put that into a trust for the cities of Philadelphia. Oh, he also did it for Boston. And it turns out, just earning interest, because again, that's what he had access to at the time, that $100,000 in today's dollars had grown to many, many millions. So it's the notion that even he understood, as long as you're compounding at something positive above inflation, you can grow to an exponential amount over time if you give it enough time.
Yeah, it's like I try to even just fathom the idea of what could we do to set up that 200-year growth. But again, that's the kind of point of today's conversation is not to get political or look at socioeconomics, but that is an example of how generational transfers of wealth help out over that many generations.
Yeah, for sure. It's this whole compounding notion. It's probably a good explanation of why, for example, again, we don't need to go too far down this path, but essentially at this point, because of this availability for equity to grow at this rate, it's led to this far differentiation in wealth. And we're at the point where 26 humans control more wealth than half of the global population. So, 26 people on one side with their wealth, and you have 3.8 billion people on the other side of the scale, and it balances out.
Yeah, I that is kind of it also goes back to the conversation we have about statistics and when we used our county population data, just how few populations it takes at such a large amount to, again, balance out a large number of small counties. So kind of similar idea. The one thing I am going to kind of inject a little bit of financial advice here. We compared the equities growing at 7% versus inflation at 3%. You kind of saw the difference over 400 years. But one of the things I do point out to my clients, and it's actually related to that previous conversations we've had about fees and how if you can get that extra 1% over 20, 30, 40 years, it really, really pays off. But this is a little more anecdotal because I guess I say my sample size isn't quite large enough and each case is a little different. But when I do projections for clients, especially over the last 10, 12 years I've been doing financial planning with them, one of the observations I've had and been able to show them is worrying about your rate of return on your investments kind of, one, just doesn't help how you feel. It's one of those things that's outside of your control. And so kind of putting mental energy into it just doesn't help your situation. But two, getting that extra 1% return actually has less impact on client lifestyles and Monte Carlo simulations of these projections than their spending and savings amounts. And this gets back to the things you can control. If clients are spending just a little bit less and saving just a little bit more, and you compound that over a working career or their 30, 40-year retirement, that actually makes a bigger impact on the Monte Carlo projections and kind of how well their net worth sustains their lifestyle than getting that extra 1% per year. So while it does make sense, I do agree with kind of academic data that keeping fees low and getting better compound returns helps. If markets only give, say, 5% over the next 5 years instead of an assumed 6 or 7%, kind of most likely clients will be just fine if we focus on the things that are within our control. That how much are we spending, how much are we saving? And just kind of, as long as we can keep saving more, that outweighs the compound impact of that extra 1%. Now, at the same time, I do tend to recommend that clients take on a little more equity risk based depending on their time frame and their comfort. So I walk them through the benefits of that. So sometimes just being more aggressive with their investments and understanding we're not going to touch this for 10 to 20 years, that can help them get to that extra 1 or 2%. And again, kind of adding on the fees, but it means that they don't have to worry about eking out those extra returns in the short term. They can really focus on just how much are they saving, and if they're saving enough, then they're on good track. On a good track.
I like that. It's interesting because I have a different perspective, but I come to the same exact conclusion as where you ended up. From my perspective, when it comes to investing, so there's this understanding that there's the actual returns that investments generate. So these are the investment returns.
Mm-hmm.
And then there are the returns that investors happen to actually get. And there's this differential where investments tend to generate these 7% returns. But when investors try to go about and do it, they tend to give up like a percent or two. And often that it's because they try to outsmart the market or get a little too fancy about things. Whereas the simpler approach is just trying to not beat the market, just trying to match it. Just say, give me that market return, and kind of let's worry about other things that we can control. Again, it's a similar line of thinking that you're putting out there. It's the notion that you can't really control whether or not you will beat the market. You can try, but it's something where ultimately, even if you put your best effort in, it's likely that your chances of success are quite low, far less than the coin flip, closer to winning the lottery in terms of probabilities. So trying to just minimize that gap and then trying to just capture that investment return is quite sensible, so that you can focus on, Aaron, I certainly agree. The thing that you can control the most, that biggest lever, is how much you save and how you go about your savings.
Yeah, I agree. That's probably the second thing. Like, one, saving more always helps. Two, I guess I don't see, and I think I've read criticisms of the Dalbar study that it's not necessarily kind of the classic fund flows example of looking at mutual fund flows, and that's how they can track investor return versus investment return, is people are pulling money out when it's down, and when it's up and it has shown good returns, there's more money going in. So there's it's kind of scarily consistent across a large number of actively managed investments. If a mutual fund has done well, then we interpret that as, oh, that manager has skill and there's more money going into that fund. And the investment that has done poorly, they interpret that as, oh, they're not as skilled and more money comes out. But then they exhibit a pretty strong reversion to the mean. And that's where the kind of the difference in investor return versus investment return. If you just pick one strategy and stick with it, you'll probably end up better than trying to adjust strategies along the way. Also, realistically, I do see issues with kind of, we've talked about this before, just they have a cash position and trying to decide when to invest it. And I have talked to people this year that, I've had money sitting in cash since spring, and it wasn't the case that they sold out of an investment. They just something happened. Either they sold a property, they had stock options that vested that they sold. Like they came up with this cash position, but markets were scary and they chose not to invest. So it's been sitting in cash most of the end of 2020. And the vast majority of investments over that time frame have been positive, not significantly positive. And so that's an example of kind of giving up those returns, even though you haven't picked an investment that did poorly. It's that kind of opportunity cost of just waiting and for the right time, that you're just better off. What is the money for? What's your time frame? Pick the investment, put it in, and ignore it for years. If you can kind of, it doesn't matter what day, just put it in, ignore it, and you'll get all the benefits of compounding, all the benefits of the risk that you're taking on, and you just have to wait more time. There's not going to be that good month or day to get in.
Yeah, I think investors kind of get hit twice from my perspective. I think they get hit once for the same reasons that you said. Basically, they either try to time or they try to seek out the most winning or whatever's hot right now and try to move money there. And it's almost always not a losing proposition, but there's an opportunity cost to that. And that's kind of what is hidden in terms of what a lot of people see as their final return. But then, at the same time, I also see the second hit that somebody may take, where if you just look at investment returns that are active in nature, and just, if you buy and hold those exclusively, there's research to indicate that you're far more likely to underperform if you put yourself in one of those vehicles.
Mm-hmm. Well, we've kind of gotten off some of the pure math and back. You just can't help getting back into that good old financial advice and client situations.
Maybe that's why we're not mathematicians.
I think you're probably right there. So, any other math things that you're thinking of that come? Because I do have one more in my notes.
Well, what I also want to emphasize is that we talk about these larger returns and these huge time periods, but realistically, you don't necessarily have 100 years or 300 years or 400 years. More often than not, you're probably thinking about an investment lifetime, the time when you first start earning money towards the time where you start decumulating assets, trying to spend that money. Mm-hmm. And, typically that's maybe a 45-year period. So that thinking about these types of numbers, you can still kind of see the power of compounding at work. For example, if you look at the last 45 years with just the S&P, it did better than that 7% average we keep talking about. It did about 10% annually. And if you just think about what an investment in that would have yielded somebody over that period, it's actually a pretty good amount of money. So if you take, for example, $10,000 in today's dollars and you move that $10,000 back to 45 years ago, that would be worth about $1,700 in 1973. And if you took that $1,700 in 1973 and just left it in the S&P for the last 45 years, that $1,700 would have grown to over $144,000. So that's well over a 10x, even factoring in inflation. And the notion is you could potentially over that period have realized that, again, this is actually something that was possible or was far more possible than our more theoretical examples of, the American Indians and whatnot. And it just kind of goes to show you that even if you're thinking about your investment lifetime, the time that you start earning money to the time that you're taking out money, that's still well enough to be able to earn a good return. And what really helps is getting that early money in sooner.
Mm-hmm. Just kind of giving yourself as much time in your own lifetime as much as possible.
Yeah, that's right.
Do you have any additional examples related to that?
Yeah, maybe just a little bit of intuition around that might help. Let's say, for example, you have young Aaron, and he's 25 years old, and he managed to put away $3,000 a year for just 10 years. And he gets this, 10% after-tax return. Well, at age 65, that 30,000 that he put in, $3,000 a year for 10 years would have grown to about $917,000. Now let's compare Aaron against his East Coast buddy Trishul, and let's say Trishul was kind of busy in his 25 to 35 year period. He didn't quite get around to it, but then at age 35, he finally got his act together and started putting $3,000 a year. Now, instead of 10 years, let's say he put $3,000 a year for 30 years. So now he's putting in 3 times the amount of money as Aaron did, but after the age 65, he's only going to be ending up with about 540,000. So Aaron, you ended up, well, I'm saying you're Aaron.
Yeah. Aaron ended up.
Cat's out of the bag. So Aaron, you ended up with almost twice the amount of money that I did, but you only put in 1/3 of the amount of money. Just because you put in that money earlier than I did, you ended up doing much better.
Yeah, so it's that from year 10 on, my $30,000 plus growth over those first 10 years. I think we sort of 10% rate of return.
Yeah, in this example. Yep.
Yeah. So you can actually kind of just figure it out. $30,000 at a 10% rate of return is already 3,000. So my growth on just my investments is already greater than your contribution starting from year 10. Then when you add the compounding aspect, my growth on my growth is always going to be greater than your growth on growth, even after accounting for the amount that you're putting in.
Yep.
Kind of the way the math works, because we're using a 10% rate of return, the numbers work really well when you save for those first 10 years. So if we kind of reduce it to 5, there'd be less of an impact. If we change the rate of return to be a little bit less, there'd be less of an impact. But that's actually a relatively realistic example. If you were to max out a Roth IRA starting at age 20, then whatever you have in your Roth IRA by age 30, if you have again, getting 10% in an all equity portfolio is not unreasonable. It's actually pretty close to its long-term historical average. That's going to be the key. It's kind of that, yeah, it might feel like you only have 40 or 50 grand after 10 years, but that 40 or 50 grand growing, averaging 10% per year geometrically over the next 30 years, that's what's going to make the big difference. And so just saving as early as possible, and in this case, kind of investing as aggressively as you can tolerate, because you know you have that long time frame, that really is the key to getting rich slowly kind of thing. It's the don't get rich quickly, but like just start early and save more.
Yeah, and it's the notion that you may not, within a few small tweaks, if you can get that savings rate to $3,000 a year in your mid-20s, you may not notice that difference. That might be not buying that iPhone, or not buying that new car or buying that used car. These little tweaks like that could net you $500,000 extra than where I ended up.
Yeah.
In this hypothetical.
And that's I like that hypothetical a lot, because it's really easy to envision both sides. That Trishul went to get a master's and then an MBA, and so you kind of had student loans. Maybe this is fictional, Trishul. I'm not going to ask you to go into your personal history. Fictional Trishul didn't start kind of making money enough to save until he got to late 20s, early 30s. And then it's like, okay, now I figured all that out. And this is one of the things that I do help clients with, that just in terms of the math. If you want to kind of catch up to that person who started saving at 20, or kind of your own fictional self, if you're doing like a cost benefit analysis or an opportunity cost comparison, you need to save significantly more than that 3,000. That if you got that extra education to try and get the higher income, you need to save a larger amount of that income. That ends up being how you have to make up for it. And so it can work. And I kind of tell clients that kind of past decisions are okay, but we can't fix them. And we're not going to get upset or reminisce or feel bad about those past decisions. But moving forward, you do have to kind of use your larger income in your 30s and save a larger percentage. that ends up being the realistic trade-off. You either start early or you end up having to save significantly more.
Right. And I'd also emphasize that even if you are late to the game, it's certainly not too late, because something we've mentioned before is that even if you plan on retiring at 65, that money that you earn in your 40s or 50s, that may not actually get spent, until your 70s or 80s, or even thereafter. So there's a good chance that that money in your 40s or 50s might be compounding for 30, 40, 50 years.
Yeah. And the other, again, kind of just way life works out, and this is, again, more anecdotal across observing different client cases. When people get to their 50s, these tend to be their peak earning years. They've built up so much experience. They've kind of built their careers the way they want to. So the 50s tend to be peak earning years. Also, a lot of expenses related to children start to tend to drop off if they're either you've taken care of college, or they're paying their own way, or even they're out of college. And so I do consistently see that people in their 50s who didn't start in their 20s, they end up being able to save those really, really large percentages of higher incomes. And that ends up being what they do to make up. It takes, again, 10, 15 years of really, really aggressive savings, but it does work out in that regard for those that kind of take it seriously. It's the people who 2 years from retirement, or 2 years from when they want to retire, thought, okay, I have this much money, I want to maintain my lifestyle, and they're not even close. They need to either significantly reduce their lifestyle or work significantly longer than they planned. So this ends up being kind of not so much the benefits of compounding, but planning far enough in advance gives you information that you can then still have time to make the adjustments.
Good stuff, Aaron.
I like that. I think one last little thing I wrote down, I don't want to forget this. I really like the Rule of 72 when it comes to math. This is the idea that if you take a rate of return, divide 72 by that rate of return, it shows how long it takes an investment to double. So, and it works just kind of because you can do it in your head. If you get a 7% rate of return, it takes 10 years to double. If you get a 10% rate of return, it takes 7 years to double. And this is just one of those quirks that I figured out a little after college, like, why does this work? And so I wrote out the formulas. One is the log 2 divided by log 1 plus x over 100. That's kind of the graph, or the visual representation for how long it takes an investment to double at a certain rate of return. Also, the graph of 72 divided by x is the curve of when you divide that rate of return, but 72 by that number. And what you see is that those two curves are just very, very similar. They're very, very close to each other. It's actually almost more coincidental. There's nothing particularly unique about being 72 or 70 or anything around that. It's just those curves line up really, really well, especially from positive numbers between 1 and 15. So kind of when you think about rates of return that investments usually generate, something on a scale of 1 to 15, it actually, those just coincidentally happen to be really, really close. If you get below 1, it actually tends to get kind of weird. You get above 15, above 20, it gets kind of weird. And if you are between 6 and 10, so think of rates of return of 6, 7, 8, 9, 10, then the error is less than 1%. Kind of between 1 and 15, the error is less than 3%. Also, 72, because it's divided by 12, it's divisible by 12. 6, 8, 9, and 12 all divide evenly into it. And it's close enough to 70 that 7 and 10 also work into it. So it is one of those interesting kind of math coincidences that if you're thinking in terms of numbers between 5 and 13, especially numbers between 6 and 12 or 6 and 10, it works out really, really nicely. So I'm guessing a lot of people in finance use Rule 72 just in their head, but haven't ever actually thought about it or figured out why it works and just the coincidence of it. So I like that when it comes to math and finance, that the curves and the formula that imply Rule 72 don't actually have anything to do with each other. It's just coincidence that it works really well between 6 and 10 or 6 and 12.
So, Aaron, what's your favorite number?
I don't really have a favorite number. It's almost like I tend to like things either like primes or multiples of 12 because I like it either no factors or lots of factors. And it's like one of my oldest daughter's in 4th grade. I've been trying to like think about this of like things like 36 I like better than 40 because you can divide 3, 4, 6, 9, 12 into it. So 72, I really like that as a number because it has lots and lots of factors. 60 is another good one because it's a combination of 12 and 5. So you get 3, 4, 5. In fact, I think it's the smallest number that is divisible by 3, 4, and 5, if I remember correctly. So I end up liking things like that. Or prime numbers. Just those are always fun too.
I thought you were going to say 72. I was kind of pitching that up for you. But you definitely sounded like it because you got your 12 and your 6s and all the other numbers you kind of wrapped up in that one number.
So you know what? If I had, now that I think about it, just 19 is the year UCLA was founded, 1919. It is also Tony Gwynn's number. So it was a combination of certain things that have a big impact on my life. And it's prime.
Nice.
What about you? Do you have a favorite number?
Oh boy, I don't know if I've thought about it enough, but since we did talk about compounding, I thought Euler's number might be a good one to throw in there.
That this is getting super nerdy among math majors. Everyone learns about Euclidean geometry in high school, and you learn about Euclid. And so when we first got to college, you see the name EULER in your math textbook. And because you know how to pronounce Euclid, you assume it's Euler. And it wasn't until much later in the class that someone used it, and the professor had to correct all of us that no, it's actually pronounced Euler. But so we were joking for next couple of years with other math majors. Is it Euclid and Euler or Euclid and Euler? That's the only way we could remember which one was which.
And it's interesting because this comes up with compounding, where if you compound something, once a year, well, that's an annual compound rate. But you can also compound something with, once semi-annually, once a month, once a day. In fact, you can compound something once every infinitesimally small length of time, and that ends up approximating Euler's number.
Yeah, that concept of compounding continuously, it's like you really have to want to combine calculus and finance to really try and understand that. But it's like, yeah, the math works out. It's you can do this and it works out just fine.
Right. And oh boy, without getting too nerdy, a way to calculate Euler's number is you just take 1 plus 1 over 1 factorial plus 1 over 2 factorial plus 1 over 3 factorial. You run that out to infinity, and you kind of get this magic number.
That's just super easy calculation right there.
Right. So it's a finite series that ends up adding up to this irrational number. Okay, too much.
No. Yeah, infinite series
Infinite series. Yeah.
adding up to a rational number.
Right. Infinite series adding up to an irrational number.
Now that you say, like, pi is another. It's not necessarily my favorite, but that was among math majors. It's a common favorite number. Everyone likes to celebrate Pi Day on March 14th and actually eat pie.
Yeah. Well, hopefully we got our kick of fun with math in this episode.
Yeah, it's we survived 2020. We need our own little chuckle. We'll get into actual serious stuff next time.
Great. Well, good stuff.
Okay. Thanks, Trishul. Thanks for your time.
Thanks, Aaron, and thanks everybody for listening. And if you're enjoying these episodes, do spread the word. Okay, thanks. Bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.